Well, we try to have a group of diverse businesses and diverse industries, but I think it's much more important to own great companies that to have some kind of proper diversification. I think with 20 to 25 names, you're diversified enough so you don't have a big weight in one single security that could really hurt you if something goes wrong. And it's also concentrated enough so that you have some odds of beating the index. Because, of course, the more stocks you own, the less the odds of beating the index. So you want the right balance in the numbers. Of course, you don't want them all in the same industry. I think it's much more important to find great companies.
So I had the pleasure of reading your annual letter recently, which I wanted to chat with you about today. So anyone who knows you knows that you're a big fan of great works of art. And on the front of each annual letter, you feature a new masterpiece for readers. And when reading your letters, I can't help but think that just the letter itself is also a masterpiece, as you really put a lot of time and effort into writing each annual letter. And I should also mention that all of your letters are on your website for Giverny Capital. I was curious if you could just talk a little bit about why you put so much time into the creative aspect of writing for your partners.
Well, I try to treat partners like I'd like to be treated if I was in their shoes. So, if I was an investor with the portfolio manager, I would want to know what he thinks, why he invested in those securities, and how is the portfolio doing, and how the companies we own are doing. So I try to give a lot of information about what's happening with the holdings, the companies we own, how the portfolio has performed, of course, over the long term. And I really try to give the information I would like to have, if I was in their shoes.
And I think on page one of every single letter, I love that you highlight to your investors that they truly are partners, as each partner is invested alongside the portfolio managers in terms of the stocks they're invested in. So everyone's in the same boat and all the incentives are aligned. Why don't most investment managers view, their investment business as a partnership?
Well, I cannot really speak for others. I would guess that it's tough because usually the right thing to do for clients, it's not exactly, not all the time, but often it's not exactly what they'd like to be doing. So, um, when the market is going down, a lot of investors want to sell or reduce their equity exposure. And, some money managers, they don't want to lose their clients and they don't want their clients to be disappointed. So they'll perhaps bend a little bit what they think would be the right thing to do, just that the client is happy. And that's a little strange because usually in any business, you want to please the client. The client is always right. I would say in investing, it's a little different. Sometimes you have to fight a little bit with your clients so that you convince them that you're doing the right thing for them long term. And I think that's why it's so important that we're in the same boat. I'm not promising results to clients. What I promise is that we'll be in the same securities. We'll own the same portfolio. If I do well, they'll do well. I think that's very important. So what I recommend to clients is what I'm doing for myself. So that's the way I've approached this business when I started it in 1998, so 26 years ago. And I think that's the right way to approach. But it's not necessarily easy on the business way of looking of doing that. But I think long term, that's the right approach.
Yeah, I think getting that pushback from your clients ties into the tribal gene you've touched on in the past. When we look back at 2024, what sticks out to you at a high level, and what did you learn from the year?
Um, That was a good year. I mean, in general, most stock market in the world did well. Most indexes, you know, more than the average year. So if you think that the long-term, equity do 8, 9, or 10% a year, most markets were higher than that this year. So it was a good year for stocks. Still, in the U.S. at least, very driven by the very, very large cap companies like the Amazon and Nvidia and Apple and Microsoft. So if you were not invested in those securities, it was a little tougher. So the S&P 500 has done much better than probably a general experience of investing in U.S. securities in 2024. I don't have the exact number on top of my head, but I think the S&P did 25% last year. But probably the weighted S&P 500, unweighted S&P 500 has done perhaps 13 or 14%. So it's been a good year, but if you were not invested in the main stocks of the S&P, it was an okay year, but not as great as the one of the S&P 500.
And in 2024, the Rochon Global Portfolio returned 13.6% after fees, and your benchmark returned 16.6%. And since your portfolio inception in 1993, your average return is 14.7% versus the benchmark's 9.4%. And when I was looking at the table that outlines the history of the fund versus the benchmark, what sort of stuck out to me is just how well the benchmark has done over the past decade. So your benchmark is a hybrid of the S&P 500, TSX, and a couple of others. In 7 of the past 10 years, the benchmark returned 16% or more, and the remaining 3 years had a negative return, which brought the average over the last decade to around 9.7%. So slightly higher than I'd say your stock market average, and not quite as high as I would have anticipated looking at all those double-digit years. What implications does the benchmark doing quite well have for your business, if any?
Well, the S&P 500 at least has done extremely well, much better than the other averages or other indexes. Mostly because, like we said, the top holdings have done so well. They've grown their earnings at much higher than average rates, but the P ratio also has increased quite a lot. So I don't exactly remember the right precise figure, but I think at the end of 2024, the top 4 of the S&P 500, so Apple, Microsoft, Nvidia, and Amazon, I think their average PE on 2025 is 33 times earnings. That's quite high historically. So it drives the whole index to an average PE of something like 23 times. But if you would consider the other 496 securities in the S&P 500, the average PE is probably 19 times, which is a little closer to historical norms. Still a little higher. We're on the high side of valuation historically.
And you had mentioned in your letter that some of your retail holdings didn't perform as well as you would have hoped. Includes companies like Five Below and Lululemon. And then some other names that did quite well are software type companies, so Meta, Alphabet, Booking Holdings, Constellation Software. Over the years, has your strategy changed in terms of the business models or industries you like to be invested in?
Not really. I think I've been always open to all industries, all sorts of companies. I really try to find great companies that have some kind of competitive advantage. It can be a little harder when you go into technology securities because this world is changing so fast. How sure can you find a durable competitive advantage? Because if the competitive advantage is not durable, it's not really a competitive advantage. So you want it to be large and you want it to be durable. And so probably with the experience of having more than 3 decades now of investment experience, I've learned that a lot of companies that are dominating in the technology field, sometimes they miss a turn and they lose their mojo, if I could use that word, and they don't maintain their competitive advantage. And You know, we could look at many, many companies that 10 years ago, 20 years ago, they were dominating, and they're not today. So I think that's a big lesson. But, we did very well with some technology companies, but I think they all had kind of a very sustainable competitive advantage, or at least they were in some kind of niche that prevented, competitors to attack their castle and the moat around the castle. And a company like Constellation Software, I think it's a very interesting example. Yes, they are in the technology industry, but I think they have very dominating business in all sorts of industries linked to the software, but a lot of recurring revenues and a lot of niche markets. And I think that makes them less vulnerable, perhaps, to new changes in the technology world. And if you look at the two companies like Meta and Google, well, Alphabet, they're not really, in my opinion, technology companies. They're advertising companies, and they've built this incredible network and these incredible algorithms, but it's not changing that fast. I mean, when you think about Facebook and Instagram, it's basically the same business today it was 10 years ago. What have changed is the number of users and the number of ads they're able to sell to all those users. And I think that's fantastic businesses.
Yeah, I can't help but think about the strong bias I can have in getting pretty interested in technology and software companies for some of the reasons you just mentioned, where these are asset light. You tend to see them scale really well. You see high margins and whatnot. Do you put your guardrails on yourself to prevent, too much concentration into one particular industry or sector?
Well, we try to have a group of diverse businesses and diverse industries, but I think it's much more important to own great companies that to have some kind of proper diversification. I think with 20 to 25 names, you're diversified enough so you don't have a big weight in one single security that could really hurt you if something goes wrong. And it's also concentrated enough so that you have some odds of beating the index. Because, of course, the more stocks you own, the less the odds of beating the index. So you want the right balance in the numbers. And I think that right balance is 20 to 25 names. Of course, you don't want them all in the same industry, but I think it's much more important to find great companies. There's many sectors that we do avoid. Everything linked to natural resources or commodities. We think it's very hard it's not impossible, but it's very hard to build a competitive advantage when you're selling a commodity. So we just stay away from those industries. And we don't like industries also that have a lot of regulation. So we're not very interested in investing in utilities or healthcare related businesses where there's lots of business with Medicare or Medicaid, so that you can be sensitive to some changes in political reimbursement rates. So, I like, for instance, medical equipment companies because I think they're much more stable than some healthcare services business. So, yes, we want diversification, but there's many sectors that we do avoid. But nothing against those sectors, just that it's very hard to have a competitive advantage in those sectors, in my opinion.
And from the beginning of your career, you've been an advocate of not trying to time the market and always being fully invested for the long term
Yes.
whenever possible. And it's easy to believe that now isn't the best time to buy stocks because we just had two phenomenal years in 2023 and 2024. And when we go back through history, it tends to show that we're in for a wild ride when we have two 20+% years for the S&P 500. What do you think people might be missing when they say today isn't a great time to buy stocks and it's a better time to stay in something like cash?
Well, you said it there, Clay. I think from day one, I wanted to be 100% invested in the stock market. And there's many reasons for that. But when I did my self-education in investing, I read all I could find on the great investors. So Warren Buffett, Ben Graham, Peter Lynch, Joe Fisher, John Templeton. And they all had different ways of finding companies and different ways of investing a portfolio. I mean, Peter Lynch could own 800 names and Warren Buffett 5. So different style, but they had two things in common. The first thing is they look at stocks as part ownership of businesses. So they were investors in terms of acquiring companies, not trading stocks. And the second thing, they all believe that you could not predict the market. So I'm not saying that they were always 100% invested, but they were convinced that the market could not be predicted. It was a waste of time to try to predict that. So from day one, I decided that my mission would be to be invested in 20 to 25 companies and to act as an owner of those companies. And if they increase their intrinsic value at, let's say, 12, 13, 40% annually, eventually the stocks will reflect that. So that's my mission, is to find companies that if I own them many, many years, eventually if the companies do well, I know that the stocks will do well. So, but you're right, there's some periods where valuation are much lower. Like I do remember very well the end of 2008 and beginning of 2009, which I labeled the opportunity of a generation, where you could find great companies at, less than 10 times earnings. Of course, you don't find those in the recent years, but my goal is not necessarily to, when I invest in a stock, is to make 15, 16, 17% annually. My goal is to optimize my capital, to put it in what I believe will do the best, will do very well. And if it's companies that will yield 12 or 13% instead of 15 or 16, well, I think that's still better than the 3 or 4% that I can get with treasury bills. So really your opportunity cost is the right way to look at things. What are the 20, 25 names that I believe are the best opportunities for my capital, for the capital of our clients at Giverny? And that's the way I look at it. So yes, I much prefer to buy, let's say, Disney at 9 times earnings instead of 18 times. But I still think at 18 times, it will do okay. Of course, it's better at 9 times, but we're not there. So that's my job, is not to wait for the perfect opportunity, is to allocate the capital and what I believe are the best opportunities that are available today. And the great thing is, with the stock market, there's always something interesting to do. There's always some companies that for some reason or the other, they're not that popular with Wall Street, and you can purchase them at reasonable valuation. And I've never, in the last 31 years I've been doing this, I don't remember a period when there wasn't some opportunity and some securities.
That's a wonderful point. I think a number of investors like to paint broad strokes on the market and say, here's what the S&P 500 is priced at. The market's expensive. But what they fail to recognize is you can sift through that list and find plenty of opportunities if you look hard enough.
Yeah, always.
So that first attribute, before you mentioned not predicting the market, you mentioned viewing yourself as an owner of businesses. And you estimate what you call owner's earnings for each company in your portfolio to judge their progress over time. I was curious if you could talk a bit about how you go about estimating the owner's earnings for each company. Hey everybody, real quick, I wanted to tell you about a very special event that TIP will be hosting here in late September 2025. We'll be hosting the Investors Podcast Summit in the breathtaking mountains of Big Sky, Montana, to bring together like-minded people and enjoy great company in one of the most beautiful settings here in the United States. While this could be considered an investment conference, it's likely much different than most investment conferences you've ever been to. Our goal is to create an unforgettable experience for our attendees and help them develop meaningful relationships with like-minded members of our audience that will last a lifetime. And what better place to do that than in the serenity of the mountains? We're inviting a select group of 25 attendees who are listeners of this show, many of which will be entrepreneurs, private investors, and investment professionals. To learn more about this unforgettable experience, you can go to our website at theinvestorspodcast.com/summit. That's theinvestorspodcast.com/summit, or you can simply click the link in the description below. For decades, real estate has been a cornerstone of the world's largest portfolios, but it's also historically been complex, time-consuming, and expensive. But imagine if real estate investing was suddenly easy. All the benefits of owning real, tangible assets without all the complexity and expenses. That's the power of the Fundrise flagship real estate fund. Now you can invest in a $1.1 billion portfolio of real estate starting with as little as $10. 4,700 single-family rental homes spread across the booming Sunbelt, 3.3 million square feet of highly sought-after industrial facilities thanks to the e-commerce wave. The flagship fund is one of the largest of its kind, well-diversified, and managed by a team of professionals. And now it's available to you. Visit fundrise.com/WSB to explore the fund's full portfolio, check out historical returns, and start investing in just minutes. That's fundrise.com/WSB. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement. Are you struggling to stay focused? If you're looking for something that can help you really hone in your work without all the distractions, Remarkable, the paper tablet might be just what you're looking for. So what exactly is a paper tablet? In short, it's everything you love about paper, but with the power of modern technology. Remarkable just released their 3rd generation paper tablet, Remarkable Paper Pro. It's thin, minimalist, and feels just like writing on paper, but comes with powerful digital features such as handwriting conversion, built-in reading light, productivity templates, and more. That means no apps, no social media, and no distractions, just pure focus. Whether you're in a meeting or deep in a creative session, this device is built to keep you in the zone. You can even try Remarkable Paper Pro for up to 100 days with a satisfaction guarantee, or you get your money back. Head over to remarkable.com to learn more and grab your Paper Pro today. That's remarkable.com.
Well, it's pretty easy. Just take the portfolio and the number of shares I own for each company and multiply that by the earnings. So I'm doing a calculation. Let's say I was a private holding company and I owned 25 companies in that holding. How would I judge the performance of my investment from one year to the other? Well, I would just calculate the earnings generated by the company owned and compare it to the previous year. So if earnings are up 12%, well, there's a good chance that the intrinsic value of those businesses has increased 12%. So that's not the perfect measurement, but I think it's consider that it's about 25 companies. The whole thing, I think, makes sense, and the valuation process is the right way to look at it. So I multiply the number of shares by the earnings per share of every company and add them up and compare it to the previous year. So I think this year it was 12% in terms of earning growth, and we have a dividend of probably 0.6%. So it add up to 12.7% when you put the two together. So that's been what I consider the intrinsic performance of the portfolio. And the important thing with the owner's earning table is to look over many years. And it's pretty incredible when you look at it, how highly correlated those two are. The performance of the intrinsic business and the performance of their stocks. In the long run, and I talk about a close to 13% annual growth in earnings per share or owners' earnings of the companies owned over the years, the securities themselves have done about 13% annually. So, and it makes sense. I mean, the stock market can be very volatile, can be very irrational from time to time, but in the long run, it always reflects the intrinsic value of businesses. And, Ben Graham used to say that the market was manic depressive in the short term, but in the long term, it was a waiting machine. And I think that's still, many decades after the intelligent investor, that's still the right phrase about the stock market.
Yeah, I love how it can help simplify the game of investing. I'm always reminded of Will Danoff in William Green's book, Richer, Wiser, Happier. He shared with William just the simple phrase that stocks follow earnings. So you illustrated the intrinsic growth of the portfolio has been closely aligned with the growth in earnings per share. And I have the numbers right here where the stock prices increased since 1996 by 3,344%. And the intrinsic value or the owner's earnings increased by approximately 3,266%. So practically 13% annual growth for each. And I also ran across this other chart online of a Meta, the stock price over the past 5 or so years alongside the earnings per share. And it's amazing the difference of when that earnings per share fell off in 2022, the stock price just got absolutely hammered. And then once the EPS recovered, market sentiment quickly recovered right along with it. I had one more question related to owners' earnings. So how do you think about reinvestments and R&D and CapEx as it relates to owners' earnings and the intrinsic growth of your portfolio companies?
Well, I guess R&D are already expense. So the earnings are, after R&D expenses, probably in terms of expenses of new investments, we'll look at that. If all the cash flows goes into CapEx and new acquisition or things like that, it's important for the long term that these are wise decisions and capital allocation is done properly. That's why I like companies that have lots of free cash flow. And not all of them, but many of the companies we own, they use that free cash flow to buy back shares. So if they grow earnings by 9 or 10%, and they buy back 4 or 5% of the shares each year, while the earnings per share increase goes to 14 or 15% annually. And we have many companies in the portfolio. I'm thinking like Booking or Fiserv. They are buying back shares aggressively. And if the stock price is reasonably valued, that's usually a very good allocation of capital. It's better than investing in other projects that are not as strong as the existing business or some acquisition that perhaps Peter Lynch would say diversification instead of just, buying back the shares of the company you already know very well and it's worth more.
Mm-hmm.
So I would say that capital allocation is very important when we look at and when we make a final decision for an investment.
Absolutely. Let's jump to your podium of errors. So each year, you famously highlight 3 errors you've made during the year or in years prior, similar to how Buffett oftentimes shares his investment mistakes in his letters as well. Can you talk about how helpful it's been for you to write down and ponder the mistakes you've made and sharing them with your partners?
Yes, I think it's a vital part of improving ourselves as investors to look at the mistakes. So I have a section in the annual letter called 5-year postmortem. So we always look at the decision, buy and sells of the 5 years ago. But the podium of error, it's really about the big mistakes. And most of them are what the Warren would call mistakes of omission, not commission, but things you didn't buy. And, there's lots of companies that I don't really understand or they are outside my circle of competence have done extremely well. And there's nothing wrong with just staying away from things you don't understand very well. But some companies I did understand very well, and I did not invest, usually for futile reason. Main one being not ready to pay perhaps a higher P ratio I'd like to. And that's a tough balance because you want to be very conservative and have a margin of safety, to get back to Bangram again. So you want to buy a company that not only has great fundamentals, but have a margin of safety in terms of valuation. But sometimes you'll miss great returns because perhaps you should have paid a little higher PE than you were ready to do. And the example of Cintas, this year's gold medal, is a good example because I knew the company very well. I understood the business, very simple business, and the valuation was reasonable, perhaps not a bargain, but reasonable. And I knew that the acquisition of G&K Services would really add to sales, earnings, and margins. And I didn't do it. And I think the stock is up 6 or 7 or 8 times since then. So it was a big mistake. So usually the big mistakes are companies that are in your circle of understanding, that you did not purchase because perhaps you wanted to be too prudent, and you should have been a little more, because great companies are not that common. So when you do find them, if the valuation is not extreme, and there are some examples that I think there are great companies with the valuation just too high, but if it's reasonable, you should purchase some shares, and if the stock go down 20%, you can just buy more. So it's not the end of the world.
Mhm. And I also wanted to touch on the final piece of your letter before I move on to a couple of your holdings, if you don't mind. So in the conclusion, you wrote about how risk management in equity investing boils down to just 4 considerations. So I was curious if you could talk about those 4.
Yeah, I thought a lot about it because the risk of an equity portfolio, I believe, is way too much focused on volatility. And I think that's not the right way to look at it. And in fact, I would say that volatility is a good thing. You want more of it. You want a lot of opportunities sometimes for a stock to go down 50% without any reason. That's not a bad thing. Just an opportunity to buy more, or even sell something else and buy more of what you already own that looks much more attractive. So I think this stereotype that risk equals volatility is not the right way to look at it. But I wanted to be very thorough and think about, what is really the risk of an investment portfolio. And I tried to come up with 4 dimensions, I would say. The first one, we talked about it, diversification. I think the right balance is 20 to 25 names. That's the right balance for me. I mean, if you talk, sadly passed away, but if you talk to Charlie Munger, probably would have said that 3 or 4 or 5 great companies is way enough. And I know some investors that have 100 names. So, but for me, the right number is 20 to 25, where, like I said, it's concentrated enough so that you have good odds of beating the averages, but it's also diversified enough that if you make a mistake, or it's just the nature of the capitalist system that sometimes companies are a victim or some random things or new changes or competition, that it's very hard to find permanent winners. So you have to accept that. So almost any company, there's always an intrinsic risk that there'll be changes in their business model or in their environment that make them a little risky, of course. And that's the second part of that process. But you have to look at the intrinsic risk of each company. But first, I think that having 20 to 25 name is diversification enough. If you have 4 or 5 name, well, you have to be very sure that you understand those business very, very well, and you have a large margin of safety in terms of the balance sheet and the valuation. But I have good friends, great investors that have done well owning 5 or 6 securities. So it's still possible. For me, 20 to 25, I'm more comfortable. So the second dimension, which is probably the most important one, is the quality of the company owned. So like I said, we want companies that have a competitive advantage, some ways that they protect their economic castle with a moat from invaders, those that want to take your castle, want to take your business. And usually great companies realize great return on capital and great margin without the use of leverage. If you need a lot of leverage to have good return on capital, it's usually not a sign that it's that great of a business. So we don't like it when companies have a lot of debt on the balance sheet. So I think the lower the level of leverage, the lower the risk, the intrinsic risk of the business. And also accounting is very important. When you analyze the intrinsic value, you try to assess the earnings. There's an old saying that earnings is an opinion and cash flow is reality. Usually the difference between the two will be aggressive accounting. So I always look at how the accounting is done at a company, and I quite often come up with my own calculation of earnings. And sometimes it's very close to what the company has announced in their on the 10K and 10Qs, but sometimes it's quite different. But that's an opinion. That's my opinion of the earnings. And I like companies that are very conservative in their accounting. And I think it's much more than just accounting. It's a sign of how the people at the top of the companies are. If they're conservative in the accounting, they are probably conservative in everything else. And if they're aggressive in accounting, they're perhaps a little aggressive in everything else too. So that's usually a kind of a sign of the company culture when they have a very conservative accounting. And we talk about Meta. If you look at Meta's financial statements, it's probably one of the simplest business I've seen, and everything is expense. So almost nothing is capitalized, and I like that. So when you look at the earnings of Meta, I like to say it's like the worst case scenario. So it's probably the real earning is probably a little higher. So you can't say that about all the businesses, I can assure you of that. So yes, the intrinsic quality of the business, competitive advantage, having a durable advantage, but also looking at the accounting and the balance sheet. I think these are very, very important. So after that, after you found companies that meet your criteria, comes a third part of the risk assessment, how much you have to pay for those companies. So that's the valuation part. And again, we go back to Ben Graham of the importance of margin of safety. You don't want to have valuation that discount many, many years of growth in advance, because, that's the nature of capitalist system. There'll be recessions, there'll be some potholes, there'll be some problems that almost every company will encounter at some point in their existence. And if you have a very high valuation that has discounted many years of growth, well, when their tough years arrive, there'll probably be a reevaluation of the P ratio by Wall Street, and those can be very painful years. So, like I wrote in the annual letter, of course, a company that trades at 40 times earnings is, if everything else is equal, is riskier than a similar company that trades at 20 times earnings. So valuation is one dimension of trying to measure the risk of your portfolio. So we have, like we talked about, the owner's earnings, but we try afterward to come up with the kind of assessment of valuation of the portfolio. And historically, if you look at our portfolio, the average P ratio has been very similar to the S&P 500. Probably it's a little lower these days because, like we explained, the S&P 500 P is a little higher than because of the top 4 of the index. But usually it's very close. So to me, we we own companies that are growing the intrinsic value by, let's say, 12% per year, plus we receive a 1% dividend. So that's a 13% intrinsic growth. And the S&P 500 probably as a whole over many years will grow their earnings 6 to 7% a year, give a 2% dividend. So you get an 8 to 9% return. So we have probably a 4% better in terms of intrinsic performance of the portfolio at a similar valuation to us. That's a level of risk in terms of valuation I think is reasonable.
Hmm.
And finally, the fourth part, which is not really linked to the companies themselves or the stock market. It's really about the investor themselves. We talked about it at the beginning of the podcast, but I think it's a mistake trying to predict the stock market. It's a mistake, but doesn't prevent many people trying to do it. And I think the more you try to predict the stock market, the more you trade in general, I think the lower the return of the portfolio. So increase trading, increase predicting the market, I think increases the portfolio's risk. And I don't think a lot of people understand that very well. And I mean, John Bogle talked about ETFs and said that it was like giving matches to a pyromaniac. So I don't remember the exact number, but I think the average holding period of the ETF of the S&P 500 is something like 17 days. I mean, how ridiculous is that? So the ease of trading of securities like ETFs gives the illusion that they have a riskless investment or approach. But in fact, the very fact that they're trading so often increases the risk of the portfolio. They're not passive investors at all. They own passive investments, but the way they trade them makes them active investors. And like I said, I think the more you trade, the higher the risk of reducing your return going forward.
Yeah, and I'll also mention that Giverny's average holding period for a stock is 8 years. I mean,
It used to be 5 years, but we've grown to be more patient over the years.
it's quite a good attribute and shows how good you are at selecting those quality companies. And when I look at the four considerations you shared here, we have diversification, quality of the business, valuation, and investors' own behavior. And to a large extent, we have a pretty big control over a lot of these aspects. We can control how diversified we are. We can control, what types of quality companies we want in our portfolio. We control what valuation we decide to enter at. We can't control the valuation the market offers us, but we can take advantage when those opportunities are given to us. And then, of course, we can control our own behavior, which, pointing to the tribal gene you've discussed before, it can be extremely difficult for some people to control their behavior during market panics.
Yeah. Well, I think if they had to return in one sentence, you want to own great companies for many, many years, and they hope that in the long term, the longer you own securities, the higher the odds that the market will reflect the intrinsic value of the business. So that's what you want to do. You want time to be on your side.
I wanted to take the chance to chat about a couple of your holdings. So according to your 13Fs, you acquired shares in Booking Holdings in Q1 and Q2 2024. And I love how with a number of your holdings, you've been following the company and the industry for 10 or 20 plus years. So in this case, you were following Expedia in the early 2000s and discovered one of their main competitors, Booking Holdings. Talk about what you admire about this business and what led to you eventually making it a core position in your fund.
Yeah, I don't know if you remember that, but Expedia was a spin-off of Microsoft. So it became public, I think it was in early 2000. And I don't think it was profitable at that time, so it didn't fit all the criteria. But I thought that the internet was really the way of the future for traveling. When I looked at that the first time, I said, well, the travel agency business, yeah, I'm not sure it has a great future. So, and I think I've been right on this, and Expedia and Booking and Priceline have done extraordinarily well, and they're almost now dominating the industry. But the transition to everything online for travel is not completed. I think it still has some good years to really be completed, if I could say that way. Um, I think personally that Booking is probably the best managed of all the companies in that industry. And I would include the recent Airbnb, which has really transformed that industry. And Booking, I think, was wise enough to realize that Airbnb was a threat, and they started their own alternative lodging business. And I think the last few quarters, that segment of the business has grown faster than Airbnb. So Booking has done a very good job of adapting to that threat. And also another good thing that I believe Booking did was probably some 6 or 7 years ago, they made the decision of transiting the business from what they call being an agent to a merchant, where they used to be mostly a third-party business, and now they acquire hotel rooms or airplane tickets or other travel items, and they sell it. So they have a more direct relationship with our clients. And also they have increased the relationship with clients in terms of using their apps instead of perhaps using a search engine like Google. So they really done a good job the last 6 or 7 years of increasing their relationship with the client, and at the same time, I believe increasing their moat. So at first, there was a cost in terms of margins because the agent had a much better margin than the merchant business. So I was a little worried at first that the margin would be much lower, and I wasn't sure if they would be able to get back to what they were, let's say, in 2016 or 17. But if you look at it, I think the highest margin in terms of net margin was close to 34% in 2014. And in 2022, it was 23%. And 2023, it was 26%. And last year is 27%. So they're not back to the level they were 10 years ago, but it's still a good margin level. And what I like about Booking is they generate a lot of cash. And I talk about the importance of conservative accounting, and Booking is very conservative. Everything is expense. So when you look at earnings, it's free cash earnings. And they've been buying back shares with that excess cash. In the last 5 or 6 years, they bought back on average 4% of the share each year. Even in the very tough year of 2020 and 2021, they were still buying back shares. And they were still profitable, which is incredible because in 2020, anything related to travel was not profitable. And Booking really continued to be profitable. Earnings went down, but still not in the red. So they've done an incredible job. And I believe when we purchased shares last year, we paid something like 19 times earnings or something like that. So the valuation was very reasonable. For a company, I believe, can grow 12 to 14% annually. And, probably a third of that will come from buybacks because that's such a high level of cash generation, and I think good capital allocation policies. So I think it's a great company, and the Q4 was very good. So so far, it's been almost a year now. It's been a portfolio. It's been a good investment.
Yeah, I'm seeing around 3.2 billion generated from cash flow from operations and around $3 billion in shares repurchased. So it's really nice when you have a 85% gross margin business plowing that much capital back into share repurchases and still able to grow in the meantime. So at first glance, the valuation does seem quite reasonable. Today, it's around a PE of 25. Your return on invested capital is over 40%. And it's almost surprising to me that it sort of trades in line with the market. Why do you think the market doesn't place a premium on this business? Is it the travel aspect, or do you think there's something else?
Well, there's of course the nature of the travel industry. I mean, it's a little bit cyclical. When there's a recession, people travel less. But we could say the same thing about ads. When there will be a recession, both probably Meta and Facebook and Google will probably experience a little bit drop in ads. So ads, travel, it's a little bit cyclical, but still great businesses. And you have to accept that it's just almost any industry, there's ups and downs in the economic environment. But what counts, again, to get back to Warren Buffett, is the moat around the business. And I think booking moat is pretty strong. And I think it has got stronger in the last 5 years. So they did good things, and we talked about that, but they did good thing to increase that moat. And I think, personally, in my opinion, their moat is stronger than Airbnb or Expedia. And what I also like about Booking is that they're very good, I think, in capital allocation, which is another positive. So not only is this a great business, but there's no diversification, to use Peter Lynch's word, and they're just buying back stock with the excess cash. And since the stock is reasonably valued, it's a good allocation. I mean, yeah, it's like you said, it's probably around 25 times trailing, but forward, it's probably 21 times estimates of this year. So it's reasonable.
Hmm.
When you think about it, it's a little lower than the S&P 500 P, but I believe that it's a superior business.
Another recent addition to the portfolio is Brown and Brown, which is a smaller holding based on the 13F I was looking at. And Brown and Brown was featured in last year's letter in the Podium of Errors. So it's yet another company you've been following for more than 20 years. It's in the insurance brokerage business. What prompted you to get back into the stock after owning it in the 2000s?
Yeah, we owned the company, I think, for 6 years, from 2003 to 2009. I think when we sold it, there was many reasons, but there was a change in management. I was a little skeptical that the new management would be as good as the previous one. And also they were entering a soft market, so earnings went a little bit sideways for a few years. And that was the reason I put it in the mistakes section. I missed it when it turned out that the new management did a great job. And also the soft market ended, and they were able to rekindle the growth rate probably in 2013 or 14. And since then, they've probably grown earnings like close to 15% annually. So it's been a fantastic business. And in fact, I would argue that most insurance brokerage businesses are quite impressive businesses. I mean, Aon is a great business, and there's another one, what's the name? Archer Gallagher, I think. It's another insurance brokerage business, and it's done incredibly well over the years. I think they've grown in the last decade, something like also 15 to 16% annually. So these are much more stable businesses than the insurance companies themselves. Because in the insurance companies, like Warren would say, surprises are really positive. You make a mistake in underwriting, you can see the results of that mistake 5 years later. So it's very hard for an investor to really assess, is the reserves and the earnings that the insurance companies are releasing, is that the reality? And they're not of bad faith, it's just the nature of the insurance industry itself. So any investment in an insurance company, you have to be quite careful. I mean, I sleep well at night with Berkshire or Markel, but some other insurance companies can be a little riskier. But in terms of the brokerage firm, like Brown Brown, they don't take risks. I think they're very solid businesses, much less riskier than any insurance underwriters. And they've grown mostly through consolidating the industry, and they've done a great job at it. And if you look at Brown and Brown, I think like I said, the last 10 years, the earnings per share has been growing at 15% annually, which is quite incredible. Yes, we've been in a hard market for a while, but I think they can continue just by consolidating, by making acquisition and increasing their level of market share. Can continue to grow at, let's say, 12 to 14% annually. Now, the question is, why do we have such a small weight, a little more than 1%? Well, the valuation was a little high. So we paid something 24, 25 times earnings, which is really my kind of maximum. Usually I'm ready to pay. So if the stock was trading, let's say, at 17 or 18 times, I would probably have the sense that I have a larger margin of safety, and I would probably be ready to have a higher weight. So I was hoping, perhaps not my partners, but I was hoping the stock would go down after we purchased it and we could increase it to 2 or 3 or 4%. But I think it's up 15 to 20% since we bought it. So the P ratios, it's even a little higher today. And look at it, I think it's, 28 times my estimates of 2025. So it's on the high side of historical norms, but still, I think it's a great company, and I think long term it's going to do well. So if by any chance the stock goes down the next quarters or years, if everything is intact, I could certainly add to it.
And Brown and Brown is run by CEO Powell Brown, who's the grandson of the founder. So the company was started back in 1939, and now it's run by the third generation family member. And I sort of see echoes of the way you run your firm, where you, of course, are treating your investors like partners. And many times with these family run companies, they're treating their shareholders like partners, because family run companies tend to think long term, tend to have a lot of skin in the game, and they're in the same boat as their shareholders as well. To what extent do you like to look for that in the companies you invest in?
I always liked it when the founder is still the CEO of the company. To me, it was always a plus. I remember many years ago, we owned Fastenal, and what was his name? Robert Kurlin was the founder and the CEO, and he owned, I don't remember, but let's say 20% of the shares. And that's one thing I like. And one reason we've owned Heiko for many years now is that we really like the Mendelsohn family. I think they've done a great job there. So we like it when the founder or the family founder is still in charge and still own a lot of shares. Of course, it's a little different when it's the third generation, but if the culture and education has been passed properly, it can be very good, and can be the equivalent of the founder being still in charge. And I think Powell Brown has done a great job.
And if we shift gears here to Alphabet, Munger has once called this one of the best businesses in the world. And I would say this historically has just been a dominant business model rather than a family run operation. And it was actually today they announced the acquisition of Wiz, a cloud security business, for $32 billion. And this company was started just 5 years ago. And it makes me ask if they're entering into the diversification phase here of their business. I was curious if you had a chance to look over the acquisition at all.
Well, I read about it. I don't have any insight, but I remember when they purchased YouTube many years ago, people were a little skeptical also, and it turned out to be an overrun. So who knows? I think when you decide to become a shareholder in a business, you have to have trust in the management judgment, I would say. If you don't trust the management, why should you be a shareholder? So I think in Google, historically, they've been around for 25 years now. Historically, has done very good acquisition and very good and wise decision. And like you said, it's one of the best business in the world. So far, I think they've proved that they know how to build a business. But It's just the nature also of that industry that it can change. And, perhaps AI can be a threat for Google. It's an opportunity, but it can also be a threat. And so many companies are trying to find ways of bypassing Google in their search. But so far, they have kept something like 80% market share in search engine. And it's been a fantastic business. And last year results were really great. So there are some worries. Some of them are political. I mean, there's some pressure from the government of trying to prove that they're a monopoly and monopolistic situation, and they want to kind of attack or break up the company. So there are some worries about what could affect them. But so far, those worries have not materialized. The company is still dominating, still doing well. But, we are aware that AI could be a challenge for Google. And, just Amazon has done a very good job in going to the similar search businesses and selling ad. So, it's not a monopoly, that's for sure, in my opinion. And but it's still a great business. And as for the latest acquisition, well, we'll see how it turns out. But I would give the benefit of the doubt to the management of Google.
Yeah, it's been amazing to me how well they continue to grow. Search queries continue to grow, ad revenue continues to grow. And I think a lot of people are just saying LLMs are coming for Google search's lunch. So we'll see how that is going to pan out over time. And it's also been interesting just to see how many value investors have been investing in Alphabet just because of course, the valuation at a share price of 160, the PE is around 18 or so, just on the platform I'm looking at here. So, of course, there's a lot of investors interested in this company, but 5-10 years from now, who knows what Google search is going to look like?
Well, Clay, when we purchased it in 2011, so 14 years ago, the main worry back then is that would Google still be as dominating in the mobile industry as they were on the desktop? And that was the main worry of Wall Street then. And the P ratio was 15 times. So this was a 25% growth company, then you could purchase it at 15 times. But there was some worries, and they were valid worries. But when we looked at it, we believed that they could adapt to this new device, and they certainly have. I don't have the numbers top of my head, but let's look at the earnings here. So this year, estimates are for Alphabet to earn something like $9 per share. And if you go back to 2018, when we bought it, it was 81 cents. So it's a more than tenfold increase in 14 years. So it's been a good growth. So of course it's much larger today, so it's going to be much harder to grow earnings that fast going forward. But I still think they can grow, around 12% a year in terms of earnings per share in the next 5 years or so. And so valuation of, like you said, 18 times is not demanding.
And speaking of LLMs and AI, I was curious if you use any of these tools in your research process or in your investing approach.
Well, I would say in the research, we can use it for sometimes. Well, we'll ask questions from ChatGPT, for instance, or Google, but it's still a competitor. But it's a very good product. And we'll ask questions of information. And we'll always validate those information that we received to be sure that there was no mistake there. But I would say accelerate the research process. If we have precise questions on historical things or data or competitive position or who are the main players in the industry. So I think it's very helpful. I don't think that it can really improve your decision process. I think that's a different thing. Gathering information quicker is not the same thing as making wiser decision. I think in terms of decision making, I still believe that human intelligence is probably more useful. So I like to use it to gather information and quicker. But when I think about investment, I try to really, like I said, to assess the competitive position, assess the quality of manager, and assess the quality of the business, and trying to always using a margin of safety, trying to get a general view of what I think the company will earn in 5 years. And I think when it concerns the future, I'm not sure that AI has any advantage over humans. I think humans still have advantage in terms of judgment.
Mm-hmm. Well, Francois, I always enjoy bringing you on the show, and I appreciate the opportunity to chat about your letter and your investment approach for the audience here. Before I let you go, how can the audience learn more about you and Giverny Capital if they'd like?
Well, it's pretty simple. We have a website, givernycapital.com, and they can go there, and there's lots of things to read.
Wonderful. Thanks so much. I really appreciate it.
Thank you. Thank you for inviting me. All those great investors never thought they could predict the stock market. So they bought undervalued securities. They could not really pinpoint the best time to buy them. And they hold those securities for the long run. And, in the end, they did well. And it's not because they were able to predict the exact perfect time to buy and sell those securities or enter or exit the stock market. It's really because they act like business owners.